Good morning. Welcome to Market Monday. Have you ever been in a hotel, about to take a shower, and you're standing there staring at these three dials, staring back at you, and you have no idea what any of them does? So what do? You venture into the unknown, of course, turn one ever so slightly. Nothing. Okay, let's try another one. Ah, water.
Then what? Gotta get the temperature right. So you turn another dial and nothing happens. So you crank it in the opposite direction, right? Still nothing. Let's go back the other way. And then you wonder if you're on candid camera. Then eventually the scalding hot water comes at you like a tidal wave. This, of course, is the concept of the fool in the shower, a term attributed to Nobel Prize winner Milton Friedman, who likened a central bank like the Federal Reserve that acted too forcefully to the person cranking dials in the shower.
That's right. Remember this? The past hiking cycles over the last 30 years? This one, of course, being the fastest. This is the equivalent to the fool in the shower cranking the dial, not feeling anything, then cranking it again. Well, the Fed has certainly been cranking, and while some things have broken, like the regional banking saga with a couple banks failing, the economy at large hasn't broken yet. And that goes back to the fool in the shower theme, that there are these large and variable lags in the economy due to the rate hikes, just like the unpredictable water temperature.
To Chad's point, though there have been some bank failures, for the most part, they've been orderly. Whether it was covering deposits over the FDIC limit or the swift absorption of First Republic into JP Morgan, the regional banking crisis has remained contained to that sector, with the regional banking index down almost 40% in just the last 3 months. And while nobody is cheering for bank failures or any type of financial disruption, this regional banking crisis has shone light on the proliferation of banks in the United States.
Matt is referencing a study from 2022 showing the number of insured deposit-taking institutions. Think banks and credit unions. Clearly, the United States has way more insured deposit-taking institutions, but it's also the biggest country, right? I mean, Canada only has 88 and Australia just 53. But even when you look at how many IDIs per million people in each zone, the US still has more than 2.5 times as many IDIs per million people than the next closest, the European Union, and over 10 times as many per million people as Canada and Australia.
It does appear that this level of bank saturation, if we can call it that, is a uniquely American phenomenon. We're not assigning morality to the topic, that this is a good or a bad thing. However, if we were to see some consolidation in this area, number one, it appears perfectly normal for that to happen. And number two, we'd put up our antennas for doom and gloom headlines, looking to fade the noise and stick to the plan.
And today we'll wrap with, what if that was the last hike? Let's look at the S&P 500 stock market since 1970. That's over 50 years, and the last hike during the various hiking cycles. The market doesn't have to go down, nor does it have to go up. We can see there's a little of both.
However, we can see that prior to the mid-80s, the market tended to head lower in the next 6 months after the last hike, whereas after the mid-80s, the market tended to head higher after the last hike. And look at the 12-month gains. More often than not, strong, positive, double-digit gains. But always in the name of context and balance, this guy right here was about a year before the global financial crisis, the carnage of which is not represented here. So we'll stay alert, stay focused, but we'll also be open to positive outcomes too. Have a great week.